Welcome back to the deep dive. We're here to crack open those dense corporate documents and basically pull out the gold for you. Today, we are definitely diving deep into a major tech player, Dell Technologies, Inc. We've got their latest Form 10K annual report right here for the fiscal year ending January 31, 2025. Our mission, as always, is to slice through the jargon, give you a really clear picture of Dell's business, their financials, how they're trying to create shareholder value, and what's coming down the pike, the opportunities and the risks. Think of this as your essential guide, your shortcut to understanding a company that's frankly involved in so much of our digital lives. Okay, let's get into it. So Dell Technologies, we know they're global, operating in, over 170 countries. They talk about end-to-end solutions. But when you look at this report, how are they actually, structured? It seems they break it down into two main business units, right? And these are the reportable segments.
That's exactly right. The first big one is the Infrastructure Solutions Group. Most people call it ISG. And this segment is really all about enabling digital transformations for their primarily enterprise customers. They're focused hard on areas like AI, machine learning, data analytics, and also multi-cloud environments, basically helping companies manage all their stuff across different clouds, public, private, even on their own premises.
Okay.
The idea is really to simplify and automate IT, make it easier to handle.
So ISG is the kind of the engine room, the heavy lifting part.
You could say that, yeah. Specifically, ISG sells servers, networking gear, and a pretty wide range of storage products. And their server lineup is quite interesting now. It goes from general purpose workhorses to these highly specialized AI optimized servers.
Oh, the AI servers. We hear a lot about those.
We do. And these are built for really intensive tasks, training those huge AI models, fine-tuning them, running inference in real time. It's a big growth area. And it's worth noting, about 60% of ISG's revenue, it comes from the Americas. So it's a very strong base there.
Okay, so that's ISG, the infrastructure backbone. What about the other major part, the Client Solutions Group, CSG?
Right, CSG, that's probably what most people think of first when they hear Dell. It's much more about the end user device. So branded PCs, notebooks, desktops, those powerful workstations, but also peripherals, displays, docking stations, keyboards, webcams, all that jazz. And it's not just hardware. They also bundle third-party software, other peripherals, and importantly, services. Things like configuration, support, deployment help, extended warranties.
Got it. So the whole package for the user.
Exactly, both for businesses and consumers. And interestingly, just like ISG, about 60% of CSG revenue also comes from the Americas. Strong regional focus there too.
Now, I seem to recall Dell having other big pieces in the past, VMware, SecureWorks. What's the story there now, based on this report?
Yeah, that's a really key strategic point in this 10K. They used to have this corporate and other segment, which included things like VMware resale and SecureWorks. But that's changed significantly. VMware, as you probably know, was bought by Broadcom late in 2023.
Right.
So Dell naturally terminated its distribution agreement for standalone VMware stuff in March 2024. And then SecureWorks, their cybersecurity arm, that was sold off too to Sophos Inc. for about $0.9 billion just this past February, right after the fiscal year ended.
Wow. Okay, so definite streamlining happening.
Absolutely. It looks like a very deliberate move to shed what they now see as non-core assets, really doubling down on ISG and CSG.
So taking those divestitures and this focus on ISG and CSG, what does that tell us about Dell's overall strategy? What's the big picture plan?
Well, connecting the dots, Dell clearly believes this sharper focus, combined with what they see as their core strengths, their huge direct sales team, their global partner network, that world-class supply chain, they believe all that positions them really well for long-term growth, especially in this data and AI era, as they call it. And a key part of that is just pouring money into R&D. They spent $3.1 billion in fiscal 2025 alone.
$3.1 billion, that's substantial.
It is. And it's aimed squarely at delivering better products, especially for AI. It's a clear pivot, really, towards being an AI-first company, both in infrastructure and client devices.
Okay, that strategic direction seems clear. But, strategy is one thing, financial results are another. Let's dive into the numbers. How did this all actually play out in fiscal year 2025?
Right, the bottom line. Well, overall, total net revenue was up 8%. It hit $95.567 billion.
Okay, 8% growth. Pretty solid. What drove that?
It was primarily driven by ISG, Infrastructure Solutions. Specifically, they saw really strong performance in servers and networking. And no surprise here, a lot of that was increased demand for those AI-optimized solutions we talked about.
Makes sense.
Looking a bit deeper, product net revenue, so hardware and software licenses that increased 11%. But, and this is important, it wasn't uniform growth. The Client Solutions Group, CSG, actually saw its net revenue decline.
Oh, really? Why was that?
It seems it was mainly due to a drop in their consumer offerings. Also, lower average selling prices and just fewer units sold overall in CSG. Plus, ending that VMware resale business obviously hit the corporate and other segment revenue, but that was kind of expected.
Okay, so mixed results across the segments. What about profitability? Let's talk gross margin. Did the higher revenue translate into better margins?
That's where it gets interesting. Total gross margin dollars did increase slightly by 1% to $21.25 billion. However, the gross margin percentage actually went down. It decreased by 160 basis points, so about 1.6 percentage points, from 23.8% down to 22.2%.
So they made slightly more gross profit in total, but less profit per dollar of revenue. Why the squeeze on the percentage?
Yeah, it's a bit counterintuitive, isn't it? The report points mainly to a shift in the product mix. They sold more of those high demand, but possibly lower margin AI-optimized servers.
Right, maybe higher component costs or just more competition there.
Could be both. Plus, they mentioned a generally competitive pricing environment within CSG, the client side. The upside was that ISG's total gross margin dollars did increase because of the sheer volume growth in AI servers and storage, even with the tighter percentage margin.
Okay, so a bit of a margin squeeze due to the product mix shift towards AI servers. How did that flow through to the bottom line? Operating income, net income. Did they manage costs well?
It seems they did manage costs pretty well, actually. Operating income was up a healthy 15%, hitting $6.237 billion.
15%, okay.
And net income, that jumped even more significantly, up 36% to $4.576 billion.
Wow, 36% jump in net income despite the margin pressure. How did they pull that off?
Well, it looks like the strong revenue growth from ISG, combined with what the report calls disciplined cost management, really helped. They managed to offset some of that gross margin percentage decline through operational efficiencies elsewhere.
Okay, impressive cost control. Now, this is where I always get particularly interested. Cash flow. Profit is one thing. Cash in the bank can be another story, especially with big hardware companies. Did the profits translate to cash?
You're absolutely right to focus there. And this is where the story gets a bit more complex. Cash flow from operations actually decreased significantly. It was down 48% to $4.521 billion.
Down 48%. That's a huge drop, especially with net income up 36%. What happened?
It really comes down to working capital dynamics. While the profit was good, it was, as the report says, partially offset by changes in working capital. Think about it. That strong demand for AI solutions, it likely meant they had to build up more inventory.
Buying those expensive GPUs, maybe?
Exactly. And maybe customers took a bit longer to pay for these bigger ticket items, so accounts receivable went up. Dell might also have taken longer to pay its own suppliers, so accounts payable also changed. All these movements, more inventory, higher receivables, changes in payables, even if temporary, they can tie up a lot of cash. It's often a sign of rapid growth in certain areas, but it hits the cash flow statement in the short term.
Right, so the demand was there, maybe even too strong for the cash cycle?
In a way, yes. And as a result, free cash flow, that's operating cash flow minus capital expenditures, also saw a really substantial decrease, down 67% to $1.958 billion. Much less cash left over after investments.
Okay, that working capital point is crucial. And Dell Financial Services, DFS, I imagine that plays a role here too, helping customers finance these big purchases.
It absolutely does. DFS is a key part of their sales engine. They funded $8.4 billion in new financing deals, what they call originations, in fiscal 2025. They maintain a pretty large portfolio, about $11.2 billion globally.
And how does that impact Dell's cash?
Well, initially, funding those deals uses operating cash flow. But then Dell often packages up those financing receivables and sells them off through asset-backed financing arrangements.
So they get the cash back later from financial institutions.
Pretty much. It helps manage their own liquidity, and the report notes their credit quality remains strong. The principal charge-off rate, basically loans they don't expect to collect, was only 0.6% in FY25, so they seem to be managing that financing risk well.
Good to know. Okay, shifting gears a bit. Beyond the core operations and the cash flow complexities, what is Dell doing for its shareholders? What does the report say about returning value?
They seem very focused on returning capital. The report lays it out pretty clearly. First, dividends. In fiscal 2025, they paid out 0.445 cents per share each quarter. That totaled about $1.3 billion for the year.
Okay, consistent dividends.
Yes, and what's more interesting is the forward look. The board approved an 18% increase in the quarterly dividend rate, up to 0.525 cents per share. That starts in Q1 of the next fiscal year, FY26.
An 18% hike? That signals some serious confidence, doesn't it?
It really does. Confidence in their future performance and cash generation, absolutely.
And what about the other main way companies return cash? Share buybacks.
They're active there too. Dell has an ongoing stock repurchase program with no set expiration date. In fiscal 2025, they bought back about 22 million shares of their Class C common stock. Spent about $2.6 billion doing that.
2.6 billion. Okay.
But here's a bigger news. Right after the fiscal year ended, in February 2025, the board authorized an additional $10 billion for share repurchases.
Another 10 billion on top of what was left.
Exactly. That brings the total amount they're authorized to spend on buybacks to roughly $11.5 billion going forward.
Wow. That is a massive authorization. Again, signals huge confidence in future cash flow.
Huge confidence, yes, and a very aggressive commitment to returning capital and boosting shareholder value that way.
Now, you mentioned Class C stock. This brings up the question of Dell's multi-class stock structure and, well, control. Who's actually calling the shots?
That's a really critical point for anyone invested in Dell. They have Class A, Class B, and Class C common stock. The key difference is voting power. Class A and Class B shares each get 10 votes. Class C shares, just 1 vote each.
10 votes versus 1. Okay.
And as of March this year, Michael Dell himself and Silver Lake Partners, the private equity firm, together held about 91.4% of the total voting power.
91%. So basically, they have complete control.
Effectively, yes. This concentration means Dell is classified as a controlled company under New York Stock Exchange rules. And that gives them exemptions from certain corporate governance standards, like needing a majority of independent directors on the board or having fully independent compensation committees. It definitely concentrates decision-making power.
Good to understand that dynamic. Okay, so we've seen the strategy, the financials, the shareholder returns, but every company faces headwinds. What are the key risks and challenges Dell highlighted in this report?
Yeah, they operate in a tough environment. The report flags several major risks. First, just the general macroeconomic and geopolitical uncertainty. Things like global slowdowns, political instability, trade tensions that can hit demand and mess with supply chains, raising costs. They specifically mentioned cautious IT spending from some big customers FY25 because of this.
The global picture.
Then there's just intense competition. The tech industry moves incredibly fast, right? Hardware, software, services, especially around AI, cloud, security. Dell faces aggressive rivals and has to constantly innovate just to keep up.
Constant pressure.
Definitely. And AI, while it's a huge opportunity, it also brings specific risks. Right now, a lot of that AI server demand comes from just a few very large customers.
Concentration risk.
Exactly. That can lead to big swings in results if one customer changes plans. It can also create pricing pressure. Plus, the rapid innovation in AI components like GPUs can mean higher defect rates or increased warranty costs. And don't forget the growing ethical and legal risks around AI, cybersecurity, IP issues, bias.
That's a whole other layer of complexity.
It is. Then there are the ongoing supply chain vulnerabilities. Dell relies on single or limited sources for some critical parts. We saw that play out with AI servers, where demand actually outpaced the supply of GPUs in both FY24 and FY25. That led to bigger backlogs.
Yeah, getting those cutting-edge chips is key.
Absolutely. Operationally, they also disclosed a material weakness in internal control over financial reporting related to how they accounted for certain supplier credits. They say they're actively fixing it, but it's something to watch.
Okay, an internal control issue.
And of course, cybersecurity threats are a constant battle, always evolving, potentially hitting operations and trust. They also mention human capital risks being highly dependent on Michael Dell, just the general challenge of attracting and keeping top talent in this market.
Right.
Financially, they carry substantial debt, around $24.6 billion. And looking ahead, they face evolving ESG, environmental, social, governance expectations and rules, plus potential impacts from things like the proposed global minimum tax, although they said that wasn't material in FY25.
Okay, quite a list of challenges. So, given all that, how is Dell planning to navigate this? What's the strategy to keep growing profitably?
Well, the core strategy seems to be continued disciplined cost management alongside what they call business modernization initiatives, which often includes things like employee reorganizations to shift resources. Their main focus is on delivering these integrated solutions, edge, core, cloud, and really positioning themselves as leaders in AI, software-defined infrastructure, and cloud-native tech.
Right, leaning into those growth areas.
Exactly. They also want to deepen customer relationships and build more recurring revenue through flexible consumption models. Think more subscriptions, more as-a-service offerings. And underpinning all that is continued R&D investment, like we discussed, and potentially more disciplined strategic acquisitions to fill gaps or accelerate growth in key technology areas.
Okay, makes sense. A focus on integration, AI, recurring revenue, and cost control. Well, that was quite the deep dive. We've really journeyed through Dell's core businesses, dissected their financial performance, the revenue growth, the margin pressures, the cash flow story, looked at their significant shareholder return plans, and explored the pretty complex landscape of risks and opportunities they face. From doubling down on AI to managing those intricate working capital needs, it's clear Dell is constantly adapting.
Indeed. I mean, their ability to manage those supply chain headaches, especially with GPUs, while still pushing innovation in AI, it's quite something. It really highlights the agility needed in tech today.
Absolutely. And it shows that even for a giant like Dell, challenges remain, whether it's shoring up internal financial controls or navigating the cash flow impact when a hot product category like AI servers really takes off. It's never static. So here's something for you, our listener, to think about. Dell is pushing hard on AI, embedding it across both their infrastructure, ISG, and their client devices, CSG. How do you think their success in truly integrating AI across both sides of their business will ultimately reshape their competitive standing? And maybe more broadly, how could it influence how quickly AI solutions get adopted in both businesses and by consumers like us in the coming years? Definitely something to mull over. Thanks for joining us on the deep dive.